When you step into the world of trading, you aren't competing against the markets. You are competing against your own beliefs, expectations, fears, and impulses. Most traders spend years searching for the perfect strategy, the perfect indicator, the perfect setup, never realizing that the real battle is internal. The market simply reflects opportunity. It is your mindset that determines whether you can recognize it, act on it, and stay consistent long enough to benefit from it. Trading at its core is a mental game. It demands a level of psychological alignment that most people have never developed because the market operates in a way that contradicts the natural tendencies of the human mind. Your brain is wired for survival. Avoid pain, seek comfort, protect what you have. But trading requires almost the opposite, accepting uncertainty without fear, taking risks without emotional attachment, and allowing the market to do whatever it will do without feeling threatened by the outcome. You don't need to predict the market. You don't need to be right. You don't need to win every trade. But you do need a mindset capable of functioning effectively in an environment where anything can happen at any moment. That single truth, anything can happen, is the foundation of the trading mindset. It removes the illusion of certainty and forces you to see the market as a fluid, ever-changing stream of probabilities. When you truly accept this, emotionally and intellectually, your trading transforms. Decisions become clearer. Results become more stable. Stress becomes manageable. You stop fighting the market and instead you begin to flow with it. The trading mindset is built on 5 core principles: absolute acceptance of uncertainty, unwavering, discipline, trust in yourself, detachment from outcomes, and total responsibility for every action you take. These principles are simple to understand but extremely difficult to embody because they require emotional reconditioning. They require you to break old patterns, fear of loss, need to be right, desire for control, and replace them with new ones: confidence, patience, neutrality, and consistency. Most traders think their problem is technical: wrong entries, late exits, inconsistent strategies. But the real issue is psychological. You can follow the same rules for days, weeks, even months, and then suddenly break them in an instant of fear or greed. That one moment wipes out progress, not because of lack of skill, but because of lack of mental structure. Your trading mindset is the container that holds your discipline together. Without the right mindset, no strategy will save you. With the right mindset, even a simple strategy becomes powerful. The market doesn't reward intelligence, it rewards emotional stability. The trader who can think clearly under pressure, detach from outcomes, and operate from a place of confidence and probability, not fear or hope, is the trader who survives. And survival in this environment is victory, because once you learn to survive, you eventually learn to thrive. Accepting that anything can happen in the market is the psychological foundation upon which all consistent trading behavior is built. Yet it is also the concept most traders resist on the deepest emotional level. The human mind seeks patterns, certainty, reassurance, and predictability. These instincts help in everyday life but become liabilities in trading where the environment operates on probabilities rather than guarantees. When you fully internalize the idea that anything can happen, you begin to free yourself from the emotional traps that destroy consistency: fear of loss, fear of missing out, hope-driven decisions, and the constant need to be right. This acceptance is not an intellectual exercise. It is a shift in your internal relationship with uncertainty. Until this shift happens, your trading decisions will always be influenced by hidden expectations, beliefs, and emotional impulses you may not realize are operating in the background. The market is a neutral environment. It doesn't know you, it doesn't reward effort, and it doesn't punish mistakes. It simply moves based on the collective actions of millions of participants, each operating with different motivations, time frames, beliefs, and information. Because of this, any moment in the market contains countless variables you cannot see or control. A perfectly valid setup can fail without warning. A trade that looks weak can suddenly explode in your favor. A strong trend can reverse instantly. None of this is personal, none of it is predictable in the absolute sense, and none of it is something you can influence. This reality frustrates most traders because they approach the market with subconscious expectations of fairness, order, and consistency. But the market does not provide those guarantees. The sooner you accept this, the sooner you remove the emotional tension that leads to poor decision-making. When you accept that anything can happen, you stop expecting the market to behave a certain way. You stop assuming that your analysis guarantees a specific outcome. You stop believing that past price action forces the market to continue in a particular direction. This shift allows you to approach each trade with a neutral mindset. Neutrality does not mean indifference, it means freedom from emotional distortion. Most traders feel excitement when a trade goes their way and fear when it moves against them. They interpret price movement as confirmation or invalidation of their intelligence. But accepting uncertainty removes these personal interpretations. A winning trade does not make you right. A losing trade does not make you wrong. A trade is simply one expression of probability unfolding in a unique moment in time. This acceptance also transforms the way you manage risk. If anything can happen, then every outcome, profit, loss, break-even, unexpected reversal, is simply part of the environment. You prepare for all possibilities before acting. You define your stop loss not because you expect it to be hit, but because you acknowledge that it can be hit at any time. You size your position according to what you can tolerate emotionally, because you recognize that no setup is certain. You enter trades knowing the market owes you nothing, which frees you from the need to force results. This is where true confidence develops, not from trying to control outcomes, but from knowing you can handle whatever outcome appears. Accepting uncertainty also reduces the emotional burden of losing. Losses become information rather than emotional events. You stop trying to avoid them because you understand they are an unavoidable part of the process. Instead of reacting with frustration or fear, you respond with curiosity and analysis. You look for patterns in your behavior, not in the market's behavior. You begin to separate your identity from your results, allowing you to trade with clarity instead of ego. When losses no longer threaten your sense of self, they lose their power over your decisions. This alone eliminates many of the self-sabotaging behaviors traders struggle with: closing winners too early, letting losers run, impulsively jumping into trades, or hesitating when opportunity arises. Another transformation that comes from accepting uncertainty is increased flexibility. Traders who resist uncertainty cling rigidly to expectations and interpretations. They believe their analysis must be correct, so they filter out any evidence that contradicts it. This narrow mindset blinds them to what the market is actually doing. But when you accept that the market can move in any direction at any moment, you remain open to new information. You can adjust quickly. You can reverse your bias when the evidence changes. You can exit a trade without hesitation when the conditions no longer support your idea. Flexibility is not weakness, it is the ability to adapt without emotional interference. It gives you the freedom to follow the market rather than impose your beliefs onto it. This acceptance also enhances patience. When you know anything can happen, you stop feeling compelled to be in a trade at all times. You realize that opportunity appears only when the market aligns with your strategy, not when you want it to. You wait for high probability setups because you understand that forcing trades leads to random outcomes. You observe the market with calm detachment, recognizing that there is no urgency, no race, no pressure to catch every move. Patience becomes a natural byproduct of respecting the market's uncertainty rather than fighting it. Accepting that anything can happen also shifts your internal focus from outcome to process. When outcomes are uncertain, the only thing you can control is your behavior. You start investing your energy in refining your rules, executing them consistently, and maintaining emotional stability. You judge your performance based on whether you followed your plan, not whether the trade won or lost. This shift creates a stable psychological framework that protects you from the emotional swings that come from being overly attached to results. Process-driven thinking leads to long-term consistency because it is rooted in what you can control, not what you cannot. Perhaps the most profound effect of accepting uncertainty is the freedom it brings. Freedom from fear, freedom from needing to be right, freedom from emotional turbulence, freedom from self-imposed pressure. When you embrace the idea that the market is unpredictable by nature, you stop trying to force certainty where it does not exist. You stop fighting an unwinnable battle. Instead, you learn to work with probabilities, manage risk, and execute with clarity. This is the psychological state that allows traders to perform at their best because their decisions are no longer clouded by emotional noise or unrealistic expectations. Focusing on probabilities rather than predictions is the psychological anchor that allows a trader to make consistent, objective, and emotionally balanced decisions in a market where certainty simply does not exist. Most traders enter the market believing that the key to success lies in predicting what will happen next. They analyze charts, indicators, news, and patterns with the hope of discovering something that guarantees the next move. But the market does not reward the need for certainty. It rewards the trader who can operate in an environment of uncertainty with confidence, neutrality, and discipline. Shifting your mindset from prediction to probability is not simply a different way of thinking. It is a complete restructuring of the way you perceive and interact with market information. When you rely on predictions, you place emotional weight on specific outcomes. You become attached to being right. You begin to believe that your analysis forces the market into compliance. This attachment creates an internal rigidity that blinds you to the actual behavior of the market. The moment the market behaves differently from what you predicted, emotional reactions begin: frustration, fear, hesitation, denial, or anger. These emotions distort perception and interfere with the logical decision-making required to trade effectively. A prediction-based mindset is fragile because it depends on being correct, but no matter how skilled you are at analysis, the market will behave unpredictably at times. A single unexpected move can break your emotional balance if you are operating from the need to be right. A probability-based mindset eliminates the emotional burden associated with predicting outcomes. Instead of expecting the market to behave a certain way, you acknowledge that each trade represents one outcome within a larger distribution of outcomes. In other words, any single trade means almost nothing by itself. What matters is the consistency of executing your edge over a large sample size. When you think in probabilities, you don't need to know what will happen next. You only need to know that your setup has a statistical advantage over time. This removes the internal tension created by uncertainty because you no longer require certainty to act. You understand that the market is not something to be controlled. It is something to be navigated with structured expectations. Thinking in probabilities also changes the way you interpret market information. Instead of looking for confirmation of your predictions, you look for evidence that supports or invalidates your edge. Your attention becomes more flexible, more observant, and less emotionally biased. You no longer cling to one belief about the market's direction. You assess each moment based on what is actually happening, not what you want to happen. This objectivity allows you to adapt quickly and rationally when conditions shift. Probabilistic thinking trains your mind to respond to information rather than react to emotion. Risk management becomes far more meaningful when you operate from probabilities. If any trade can lose regardless of how perfect the setup looks, you treat every trade with equal respect. You size positions correctly because you recognize that protecting your capital is the foundation of long-term survival. You set stop losses not because you expect them to be hit, but because they protect you in the event that the trade lands on the losing side of your statistical distribution. Each trade becomes just one of many. This perspective removes the emotional pain of individual losses because you understand that losses are a natural, expected part of any probability-based system. A probability mindset also frees you from the destructive influence of overconfidence. After a string of winning trades, prediction-oriented traders often become convinced that they have figured out the market. They begin to take larger risks, break rules, and assume they cannot be wrong. This inflated sense of certainty is one of the most dangerous psychological states a trader can fall into because it blinds them to real-time information and increases vulnerability to sudden market shifts. When you think in probabilities, winning streaks don't inflate your ego and losing streaks don't destroy your confidence. You understand that both are part of the natural ebb and flow of trading outcomes. Your emotional stability becomes much stronger because your expectations are aligned with the true nature of the market. When you embrace probabilistic thinking, you stop tying your self-worth to your trade outcomes. A winning trade is not proof of superiority or intelligence. A losing trade is not evidence of ignorance or incompetence. You begin to see trades as neutral events, just numbers in a mathematical sequence. This neutrality protects your mind from the psychological turbulence that ruins decision-making. Without emotional attachment, you can evaluate your performance honestly, identify mistakes without shame, and improve your process without resistance. This mental clarity accelerates growth and builds the foundation for long-term consistency. Focusing on probabilities also enhances patience. If your edge requires specific conditions to deliver a statistical advantage, you learn to wait for those conditions. Instead of forcing trades out of boredom or anxiety, you stop chasing every move the market makes. You stop overtrading. You stop reacting impulsively. Waiting becomes natural because you understand that every trade you take outside your edge weakens your long-term expectancy. Patience is no longer a struggle. It becomes a natural extension of thinking in probabilities. Another powerful shift occurs in the way you experience uncertainty. Instead of fearing it, you begin to respect it. You recognize that uncertainty is what creates opportunity in the first place. If everything were known and predictable, there would be no room for profit because the market would instantly correct itself. By understanding probabilities, you embrace uncertainty as a necessary part of the environment. This acceptance removes the emotional pressure to predict the future. You become comfortable acting without knowing. You stop seeking certainty and start executing with confidence in your process. Thinking in probabilities also strengthens discipline. When you know that your edge only plays out over a large number of trades, you become committed to following your rules with precision. You no longer feel tempted to deviate from your plan based on intuition or emotion. Discipline becomes the vehicle through which probabilities express themselves. Without consistent execution, even the best edge becomes meaningless. But with disciplined execution, even a modest edge can produce remarkable results over time. A mindset built on probabilities creates internal stability. You no longer swing between hope and fear, confidence and doubt, excitement and panic. Your decisions become calculated rather than impulsive. You remain present in the moment instead of projecting expectations into the future. You don't need the market to behave a certain way for you to feel safe. You trust your process because you understand that the outcome of any single trade is irrelevant compared to your long-term expectancy. This stability is the hallmark of a mature trader, one who no longer fights the market or themselves, but operates with balanced awareness and mental clarity. When you internalize the principle of probabilities, trading becomes less about chasing outcomes and more about managing decisions. You shift from needing control to exercising discipline, from reacting emotionally to responding logically, from believing you must be right to knowing you must be consistent. Detaching emotionally from outcomes is one of the most difficult psychological transitions a trader must make because it requires breaking a lifetime of conditioning that links results to self-worth, security, and identity. From childhood, people are taught that good results mean success and bad results mean failure. This creates a mental framework where every outcome becomes a reflection of who you are. In trading, this mindset becomes destructive because the market produces random distributions of wins and losses regardless of your skill, intelligence, or effort. If you treat every outcome as a personal statement about your ability, you trap yourself in an emotional cycle that distorts decision-making. Emotional attachment to results creates fear when trades move against you, excitement when trades go in your favor, frustration when outcomes differ from expectations, and hesitation when uncertainty feels threatening. Each of these emotional responses becomes an obstacle to consistency because emotions replace logic as the driving force behind your decisions. Detaching emotionally from outcomes does not mean ignoring them. It means removing the emotional meaning you assign to them. A losing trade does not mean you made a mistake. A winning trade does not mean you made the right decision. Outcomes reflect probabilities playing out, not personal value. When you detach from outcomes, you stop internalizing each result as a verdict on your skill. Instead, you see results as neutral data points that belong to a series, not isolated conclusions. This shift is essential for achieving consistency because consistency requires acting from a place of clarity rather than emotional turbulence. When emotions dominate, traders often respond impulsively. Fear makes them close trades too early or avoid taking valid setups. Hope makes them hold losing trades longer than their risk allows. Greed pushes them to increase position sizes beyond what their plan permits. Regret causes revenge trading, trying to force the market to give back what it took. Emotional attachment creates a psychological roller coaster where each tick of price movement triggers reactions rather than decisions. But when you detach from outcomes, you free yourself from the emotional push and pull that clouds judgment. You no longer react based on the need for the trade to work. You act based on what your plan says should be done. Detachment also eliminates the pressure of needing to be right. Many traders enter positions with the subconscious belief that their analysis should make the market go their way. When the market doesn't comply, they experience anger, fear, or confusion because the outcome contradicts their expectation. This emotional dissonance leads to denial, refusal to close losing positions, or stubbornly holding onto a bias long after the market has invalidated it. The need to be right is one of the most damaging psychological forces in trading. But when you detach from outcomes, you stop seeing the market's behavior as a challenge to your ego. You stop fighting to prove something. Your focus shifts from being right on this trade to being consistent across many trades. A major part of emotional detachment comes from accepting the probabilistic nature of trading. When you truly understand that each trade is just one of many, and that any trade can result in a win or loss regardless of how good the setup looks, the emotional significance you attach to individual outcomes naturally weakens. You realize that no single trade holds the power to define your trading journey. This frees you from the anxiety that comes from obsessing over each result. You no longer fear taking losses because you understand they are inevitable. You no longer overvalue wins because you recognize they are simply part of the distribution. This balanced emotional state allows you to approach each trade with calm neutrality. Emotional detachment also transforms the way you perceive risk. When you are attached to outcomes, risk feels threatening. You fear losing money because losing money feels like losing control, losing validation, or losing confidence. This fear often causes traders to break rules, move stops, or avoid taking trades. But when you detach emotionally, risk becomes a necessary and manageable part of the process. You define your risk before entering a trade because you recognize that outcomes are uncertain. You accept the potential loss fully, not as a negative judgment, but as a cost of doing business. This acceptance reduces emotional friction and allows you to execute decisions without hesitation. Another powerful effect of emotional detachment is improved objectivity. When you are emotionally connected to outcomes, you filter price action through your emotions. You see what you want to see instead of what is actually happening. Bias becomes stronger, flexibility becomes weaker, and your ability to adapt diminishes. But when you detach emotionally, your mind becomes clear enough to observe without distortion. You can identify when a trade is no longer valid. You can exit without emotional resistance. You can reverse your bias when the evidence shifts. Objectivity becomes a natural result of emotional neutrality. Detachment also increases consistency. Emotional attachment leads to inconsistency because emotions fluctuate with results. When you feel confident, you take trades aggressively. When you feel afraid, you hesitate. When you feel frustrated, you take impulsive actions. This inconsistency destroys the edge of even the best strategy. But when you are emotionally detached, your actions are dictated by rules, not moods. You follow your plan whether the last trade won or lost, whether the market feels favorable or dangerous, whether your confidence is high or low. Consistency is the product of stable emotional conditions, and stable emotional conditions come from detachment. Detaching emotionally does not mean suppressing emotions. It means understanding them so deeply that they no longer control your decisions. When you allow emotions to exist without giving them authority, they lose their power. You recognize fear, but do not act on it. You sense excitement, but do not let it influence your judgment. You acknowledge frustration, but do not let it alter your discipline. This internal mastery is what separates professional traders from those who struggle endlessly. Professional trader experiences emotions the same as anyone else, but has trained themselves not to interpret outcomes emotionally. A critical component of detachment is redefining success. Success in trading is not measured by the result of a single trade, but by adherence to your process over time. When your definition of success shifts from outcome-based to process-based, emotional attachment loses its foundation. You judge your performance by whether you followed your rules, not whether the trade won. This reframing removes the emotional weight from outcomes because outcomes no longer determine how you feel about yourself or your progress. The more you align your identity with discipline rather than results, the easier detachment becomes. Emotional detachment also opens the door to continuous improvement. When you are attached to outcomes, mistakes feel painful. You avoid analyzing losing trades because they threaten your self-image. But when you detach, mistakes become valuable sources of information. You can evaluate them honestly and make adjustments without guilt, denial, or defensiveness. Growth becomes smoother because your emotional resistance weakens. You learn faster when you are not emotionally burdened by outcomes. Ultimately, emotional detachment creates freedom, freedom from fear, freedom from ego, freedom from the internal conflicts that sabotage performance. It allows you to participate in the market with a calm and stable mind, to make decisions from clarity rather than emotion. Maintaining discipline over every decision is the cornerstone of consistent trading because it ensures that your actions align with your plan rather than your emotions. Trading is an environment where uncertainty, volatility, and randomness are always present. Without discipline, these forces pull you into impulsive decisions, reactive behavior, and emotional responses that undermine your edge. Discipline is not simply the ability to follow rules, it is the psychological strength required to override instinctual impulses that conflict with your long-term objectives. The human mind is naturally wired to avoid discomfort, seek immediate gratification, and respond emotionally to perceived threats. The market constantly triggers these instincts, and without discipline, you will be guided by emotion rather than logic. This is why maintaining discipline is not just a trading skill, but a psychological transformation. Discipline begins with having a clear, well-defined plan. Without a plan, the mind has no structure to rely on, and decisions become subjective. A plan removes ambiguity. It defines what a valid setup looks like, when to enter, where to place your stop, how to manage risk, and when to exit. But even with a solid plan, discipline is required to execute it consistently. Many traders know what they should do, but fail to do it because emotions override logic in critical moments. Fear makes them hesitate. Greed makes them chase. Impatience makes them enter early. Frustration makes them break rules. Discipline is the force that keeps you aligned with your plan despite these emotional pressures. Maintaining discipline also requires emotional neutrality. When you become attached to the outcome of a trade, emotions intensify. The more meaning you assign to a trade, the harder it becomes to follow your plan. Discipline weakens when emotions take control, because emotions demand immediate action. They push you to avoid pain or seek pleasure, regardless of whether those actions support your long-term goals. A disciplined trader recognizes these internal pressures but does not act on them. Instead, they rely on their rules as the guiding framework. This ability to act according to plan, even when emotions resist, is the essence of discipline. A major challenge in maintaining discipline is the unpredictability of reinforcement. In trading, bad behavior can sometimes be rewarded. Entering impulsively might still result in a win, and following your plan perfectly might still result in a loss. This inconsistent reinforcement confuses the human mind because it contradicts the typical learning pattern where good behavior leads to good outcomes and bad behavior leads to bad outcomes. In the market, outcomes are distributed randomly across any series of trades. Without discipline, this randomness can lead you to form destructive habits, believing that risky or impulsive behavior is acceptable because it worked once. Discipline protects you from this psychological trap by grounding your decisions in rules rather than outcomes. Discipline also plays a critical role in risk management. Risk is unavoidable in trading, but when discipline falters, risk becomes dangerous. Traders who lack discipline move stop losses out of fear, increase position sizes out of greed, or take trades outside their strategy because they feel pressure to make something happen. These behaviors expose the account to unnecessary danger. Maintaining discipline ensures that every trade has predefined risk and that risk is never allowed to grow beyond what your plan permits. Disciplined risk management is not optional, it is the foundation of survival. Without survival, there can be no long-term success. Patience is another expression of discipline. The market offers endless movement, but not endless opportunity. Most price action is noise, not a setup. A disciplined trader waits for the conditions that align with their edge, resisting the urge to act just because the market is moving. Impulsive trading is a symptom of weak discipline, where the desire for action overrides the logic of waiting for high-quality setups. Patience reinforces discipline by teaching the mind that doing nothing is often the most strategic choice. This is one of the hardest lessons in trading because it contradicts the instinct to constantly participate. Discipline is what keeps you on the sidelines until your plan signals the right moment. Consistency emerges from discipline. Without discipline, your actions fluctuate with your emotions, making your results unstable. One day you follow your rules, the next day you break them. One trade you size correctly, the next trade you double your position. This inconsistency destroys any statistical advantage your system might have. A strategy only works when it is applied consistently across a large sample size. Discipline ensures this consistency by eliminating deviations from your rules. When you act the same way under varying emotional conditions, your edge has the chance to manifest over time. Maintaining discipline also requires an understanding of your psychological triggers. Everyone has internal patterns that influence behavior: fear of losing money, fear of missing out, need for validation, impatience, frustration after losses, or overconfidence after wins. These triggers can push you into impulsive or destructive decisions if they remain unconscious. A disciplined trader becomes aware of these emotional triggers and designs rules, habits, and routines to counter them. This could include pre-trade checklists, journaling, meditation, or predefined criteria that must be met before taking action. Discipline is strengthened through self-awareness because you cannot manage what you do not recognize. Another dimension of discipline is accountability. Traders who blame the market, news, brokers, or outside forces for their losses weaken their discipline. Accountability brings control back to the individual. When you accept full responsibility for your decisions, you strengthen the mental structure that supports discipline. You cannot change the market, but you can control your behavior. This mindset empowers you to refine your rules, adjust your execution, and improve your consistency. Accountability reinforces discipline by preventing emotional excuses from undermining your progress. Discipline must also be present during winning periods, not just losing ones. Many traders believe discipline is only necessary when things go wrong, but it is equally crucial when things go right. Winning streaks create a deceptive sense of confidence that can lead you to take risks you normally avoid. You may feel invincible, which encourages larger positions, premature entries, or relaxed risk controls. This is the silent danger of success. It erodes discipline by convincing you that you are above your rules. A disciplined trader treats every trade the same, regardless of recent outcomes. This prevents emotional inflation from destroying the consistency that created the winning streak in the first place. Maintaining discipline also involves detaching from the allure of perfection. Many traders sabotage themselves by trying to avoid any loss or mistake. This perfectionistic mindset creates fear and hesitation, which leads to missed opportunities or impulsive decisions. Discipline requires accepting imperfection as part of the trading process. You follow your rules knowing that losses will happen, mistakes will occur, and nothing will ever be flawless. This acceptance frees you from the emotional pressure that disrupts your discipline. Ultimately, discipline becomes a habit developed through repetition. The more consistently you follow your rules, the stronger the neural pathways supporting disciplined behavior become. Over time, disciplined actions feel natural, while impulsive actions feel foreign. This psychological evolution is the key to long-term trading success because discipline becomes an internal standard rather than an effortful struggle. Taking complete responsibility for your actions is the psychological turning point that separates consistent traders from those who remain trapped in cycles of frustration, confusion, and repeated mistakes. Responsibility in trading is not just about admitting when you were wrong, it is about recognizing that every decision you make, every entry, exit, position size, stop-loss placement, and emotional reaction is entirely under your control. The market does not force you to act. It does not influence your mindset. It does not dictate your behavior. It simply provides information. What you choose to do with that information is yours alone. Accepting full responsibility means acknowledging that your results are a direct reflection of your choices, not the market's behavior. This shift in perspective empowers you because it brings all control back to where it truly belongs, within yourself. When traders avoid responsibility, they unconsciously give their power away. They blame the market, believing it moved unexpectedly. They blame news events, thinking they were caught off guard. They blame brokers, algorithms, volatility, or other external factors. This mindset creates a psychological environment where improvement becomes impossible because responsibility is placed outside the self. If something outside you is at fault, then there is nothing you can do to change. This creates a loop where the same mistakes are repeated because the trader never examines their own decisions deeply enough to correct them. Blame becomes a shield that protects the ego but destroys progress. Taking complete responsibility breaks this cycle. Instead of asking why the market moved against you, you ask why you were exposed. Instead of wondering why volatility spiked, you examine whether your risk parameters accounted for it. Instead of feeling betrayed by a stop-loss hit, you analyze whether the placement was logical or emotionally influenced. This internal focus shifts your attention from external events to internal processes. You begin to see that the only thing standing between inconsistency and mastery is your own behavior. This realization is powerful because it opens the door to growth. Responsibility also changes the way you interpret losses. When you do not take responsibility, a loss feels unfair. It feels like something happened to you. This emotional framing creates resistance to analyzing losses objectively. But when you take full responsibility, a loss becomes a data point, an opportunity to learn. You begin to see patterns in your behavior, impulsiveness, hesitation, rule-breaking, emotional decisions that contributed to the outcome. Instead of feeling victimized, you feel informed. You gain insights that allow you to refine your strategy, improve your discipline, and strengthen your mindset. Another essential part of responsibility is recognizing your role in emotional reactions. Traders who lack responsibility often believe emotions just happen. They think fear, greed, anger, excitement, or frustration are caused by the market. But emotional responses are internal. The market does not create fear. Your interpretation of risk does. The market does not create greed. Your attachment to potential profit does. The market does not create frustration. Your expectations do. When you blame the market for your emotions, you lose the ability to regulate them. When you take responsibility for your emotions, you gain the ability to understand, manage, and neutralize them. Emotional mastery begins with accepting that every emotional reaction is an internal choice shaped by beliefs and expectations. Taking full responsibility also strengthens discipline. A trader who blames external factors cannot maintain discipline because discipline requires self-governance. You must be willing to hold yourself accountable to your rules even when it feels difficult. This becomes easier when you accept that your rules exist to protect you from your own psychological tendencies. Responsibility reinforces discipline by making you aware that any deviation from your plan is a choice you made, not something the market forced upon you. This awareness eliminates excuses and strengthens your commitment to consistency. Risk management also improves dramatically when you accept responsibility. Traders who blame losses on external events often treat risk reactively rather than proactively. They widen stops, hold losing trades, increase positions randomly, or chase the market out of emotional pressure. Responsibility shifts the mindset from reaction to preparation. You begin to define risk clearly because you recognize that protecting your capital is your responsibility alone. You stop hoping the market will cooperate because hope is a substitute for responsibility. Instead, you create rules that account for uncertainty and accept that your job is to follow them without exception. Accountability also plays a crucial role in strategy development. Traders who avoid responsibility often jump from system to system, looking for an external solution to internal problems. They believe a better indicator, pattern, or technique will fix their inconsistency, but inconsistency is not caused by the strategy, it is caused by behavior. When you take responsibility, you stop searching for external fixes and begin refining your own execution. You look for weaknesses in your decision-making. You identify emotional triggers. You create routines that support consistency. You test and evaluate your strategies with honesty rather than ego. Responsibility removes the illusion that the strategy is the problem and allows you to see clearly that execution is the true challenge. Another transformation that responsibility brings is increased confidence. When you stop blaming external factors, you stop feeling powerless. You realize that you are capable of making consistent choices, managing risk, controlling emotions, and following your plan. Confidence grows from competence, and competence grows from responsibility. Blame destroys confidence because it reinforces helplessness. Responsibility builds confidence because it reinforces control. A responsible trader understands that while they cannot control the market, they can always control their behavior. This control becomes the foundation of stable, unshakable confidence. Taking responsibility also reduces fear. Fear thrives when you feel vulnerable and out of control. Traders who blame the market feel threatened by it. They feel the market is unpredictable, dangerous, or unfair. This fear leads to hesitation, premature exits, or avoidance of valid setups. But responsibility changes your relationship with fear. When you accept that your behavior determines your results, you stop fearing the market and start trusting your ability to respond. Fear diminishes because you no longer depend on prediction or control. You rely on preparation and discipline instead. Responsibility is the antidote to fear because it eliminates the perception of helplessness. Another aspect of responsibility is humility. When you accept that your decisions create your outcomes, you begin to see the limitations of your knowledge and the influence of your biases. This humility keeps you grounded. It prevents overconfidence. It keeps you open to learning. Many traders fail because arrogance blinds them. Responsibility dissolves arrogance and replaces it with clarity. Humility becomes a tool for growth because it allows you to see mistakes without denial or defensiveness. Responsibility also deepens focus. When you stop blaming the outside world, your mind becomes more present. You stop worrying about what might happen and focus on what you can control right now. This focus improves decision quality, reduces noise, and strengthens your ability to follow your plan. Responsibility turns your attention inward, sharpening awareness and increasing precision. Ultimately, taking complete responsibility for your actions is the foundation of mastery in trading because it aligns your mindset with the true nature of the market. It removes illusions, excuses, emotional distortions, and the psychological barriers that keep traders stuck. It empowers you to grow, adapt, and improve continuously because every result becomes feedback rather than judgment.